Hello, this is Eric Boyce, President, CEO, and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for February 12th of 2023. Please see our disclaimers for important information. Well, before we get started on the chart pack this week, just want to let you know, as you can already see here, that we've undergone a name change and a rebrand. And so instead of BK Wealth Consulting, we are going to begin the transition of changing our name and all of our written product and all of our online presence, etc., to Boyce & Associates Wealth Consulting. And so here you see that change represented in the chart pack this week, and just a heads up, you'll begin to see that in a lot of other places as well. So very excited about that, and looking forward to sharing more about that name change and rebrand with all of you. But as we get started today, we had some data on payroll coming over the wires over the last week or so. Here we've got a representation, Department of Labor data, in kind of a disaggregation, if you will. You see the change in non-farm payrolls since February of 2020, pre-pandemic. And labor market is very strong, and this is how it kind of breaks out. So you've got, the overall line, we've exceeded the prior levels of employment before the pandemic. You see leisure and hospitality has come back actually quite strong during the balance of 2022. Information technology, we'll see a little bit of data points here later where especially large tech has been laying off a lot of people. So you see that level of payroll growth really flatlining, and then you see goods performing. Even though the goods sector has been weak from an economic standpoint, you see labor continue to increase in that sector, at least from a payroll standpoint. Now here's a quick look at the unemployment rate. Again, 53-year low, 3.4%, unusually low at this point in an economic cycle where you'd expect that number to begin to go up. Now, just as a heads up that we do see several data points in terms of hiring intentions, in terms of the JOLTS job openings numbers, beginning to soften up. So, feel like the only trajectory here is up. In terms of the unemployment rate, but it's just oddly very sticky. Labor markets are very strong, much stronger than you'd expect if you're getting ready to head into a recession. Here's a wage growth tracker. We've shown this type of data to you in the last probably the month or so, where we can have where there's visible evidence of wages kind of rolling over, albeit from a very high point. And so we've had perhaps a peak in overall wage growth in the 6 to 7% range. Now again, that's ebbed a little bit, maybe a percentage point, but it's still pretty high. So obviously it's trending in the right direction if you're a Fed watcher and you're interested in where peak interest rates are and perhaps where the end of the rate tightening cycle is going to fall. But again, more data to come, and hopefully we'll begin to see this trend kind of solidify in the coming months. Here's non-farm payrolls again showing the labor market very strong right now, but those amber lines kind of moving forward, it represents Morgan Stanley's view of things, and it's very consistent with what I've seen in some of the other houses where we have degradation in non-farm payroll growth before we see it begin to turn back up perhaps in 2024. Here's our unemployment rate forecast, and this is Wells Fargo. So looking at a different shop here, you can see the unemployment rate very low right now. We just said, we showed you the data, and expected to kind of tick back up. And I'd say 5% is pretty consistent with what we've seen from some of the other firms, moving up from 3.6 where it is currently, and then at some point kind of maybe rolling back over. I think that's a little bit more in dispute, but I think unemployment moving up to 5% is very, very consistent right now. A little bit noisy here, but then we've got basically the ISM Manufacturing Purchasing Managers Index, and that right now is below 50. That's a diffusion index, so anything below 50 represents contraction. So ISM, their manufacturing index, is showing contraction. And so as noisy as this chart is, there is a high degree of correlation, positive correlation, meaning that non-farm payrolls would be expected, generally speaking, kind of to follow manufacturing PMI. And so if that's falling, then you'd expect non-farm payrolls to fall, which is consistent with what we saw in a couple of charts ago in some of the big, large investment bank research houses are expecting payrolls to drop. So again, this is kind of the data behind these estimates. This is ISM manufacturing PMI is a bit of a leading indicator. So we'll continue to watch that for sure. Here's a chart of major tech layoffs. And you can see here Amazon to Dell, Google, IBM, Microsoft, etc. And you see the number of laid off in kind of that light purple there. And so these bars are pretty high, right? And then percent of workforce is in that green. And you can see, when you get to Zoom, then you're dealing with 15% of its workforce. And then obviously with Amazon, they're very huge. Dell, some of these firms are extremely large, but in the cases of the super large firms, I mean, you're dealing with essentially 2 to 5% of the workforce, and you get over to PayPal and they're getting rid of 14, 15%. This is meaningful, and this is very broad across the tech spectrum right now. Now, some other data points to discuss here. This is essentially inventories, and inventory can be a big swing factor in economic growth, both positive and negative. And right now we have a lot of inventory on the shelves, and this is the inventory to sales ratio. So this can be influenced multiple ways. Either you can raise your inventory, or you can reduce your sales, or you can do both. And there's maybe a little bit of both going on, and you can see inventories are increasing at a pretty good clip here. And so this has the effect over time, if sustainable, to help bring inflation down. Now, this is looking at motor vehicle parts. This is inventory to sales ratio in that particular category, which is actually pretty interesting. So, where we've seen a lot of tightness in the vehicle space, I mean, this one caught my eye as I was looking at the other inventory data, that auto and parts and supplies and that whole automotive space, which have been extremely beleaguered with supply chain constraints for quite a while, now appears to be lightening up quite a bit. Here's some charts on the costs of transportation, if you will. We've got, in the left-hand side, we've got container freight rates that are down. You can see 80% in that bottom left chart. These freight rates are down 80%. And just think about that. That's pretty profound. On the right-hand side, we've got trucking rates. And you can see a similar pattern here is that these rates have gone down quite a bit too. So transportation, motility costs for goods in process and intermediate goods and intermediate stages of production, these costs have gone down a lot. So a quick look here on copper. We talk a bit about the reopening of China. What are the implications here? And there are a lot of people that feel like reopening of China is going to be inflationary. And I don't disagree with the impulse of that, meaning the reopening and the demand for industrial commodities like copper here. So you can see here, this is Fitch Solutions. This is their forecast. They expect copper prices to move higher. And you can see in that blue area where they had skyrocketed during the pandemic and then plateaued and then came down very precipitously, as we've been talking about over the last several months, and they've just begun to eke up. And so I do think China's reopening will provide inflationary pulses throughout the globe, but I do think that there are other things that will offset that and then be a net negative for inflation trends moving forward. Well, as we look at copper, we need to look across the entire basket. And so, what I see here and what we just saw were copper prices. And what we're looking at here is the inventory to sales ratio for lumber and other construction materials. And so, obviously we're in a bit of an upheaval in the housing sector, residential housing sector. Commercial sector has been pretty lax in terms of activity over the last year, not too surprisingly. But here you see basically inventories moving higher in a lot of these construction components, which is inherently disinflationary. As it pertains to home price impulses, you think about the cost of producing a new home, and that was very difficult particularly a year and a half ago, as some of these commodities were really out of the gate and just crazy high. Well, those have come down quite a bit. Now we see inventories are moving higher, and just as we saw with the overall inventory to sales number a few slides ago, we see this one clearly suggesting that it will help drive inflation down. Interest costs here, this is basically out of the OMB, Office of Management and Budget. And, you think about all the years that we have very, very low interest rates and basically zero short-term interest rates. Well, this is essentially the cost to the government of funding the government. We benefited for a long time with low debt service costs, and that's moving higher. And one of the consequences, of course, of raising interest rates, if you're the Federal Reserve, is creating a situation where your funding costs as a government are much higher. And of course, the Fed is supposed to be independent, but nevertheless, we do see that the interest cost as a percent of GDP now 1.8 and moving absolutely higher from here, and you can see where we've come from over the last several years. So this is an interesting chart, talk about the Russian invasion of Ukraine and all of its collateral impacts. We talk about the energy issues that were inherent in Europe, so on and so forth. But this is a chart of Indian imports from Russia. And you can see where, a lot of the speculation that Russia was going to go into a major economic funk. Well, they're certainly in an economic funk, but it's not nearly as bad as it would be if you didn't have this, in India essentially ramping up its imports from Russia. And looking at China, so we just talked about the Chinese reopening, and so here we've got consumer price inflation of about 2.5%. You can see where that's come up a little bit. Producer prices are still negative, but the fact that we've got Chinese inflation that's beginning to kind of reassert itself a little bit has driven quite a few folks to speculate that this is going to lead to a lot of other inflation around the globe. And I'll just reiterate my point from about a minute or two ago, and say that while this in a vacuum, if there are no other impulses out there, it certainly would help drive inflation around the world due to the increased demand from the Chinese consumer at all. But there are disinflationary pressures around that help to offset this. But again, just keeping current here with what's going on in the Chinese economy, particularly here as it relates to inflation. And looking at the trades good with China, it's interesting to note that despite all these tariffs and the trade barriers that not only the Trump but also the Biden administrations have established, put in place, or maintained, you can still see here that our trade deficit with China is not necessarily going down, but it's actually increasing. As we look at some of the dynamics going on in the oil patch here, Russia just announced it is going to curtail production by 500,000, using oil clearly as an economic weapon, and you can see the attendant impact on pricing here over the last several days, and that announcement came out on the 10th, and you can see what it did from there. Again, not tectonic, moving it from $84 a barrel to $87 a barrel, but I would expect further volatility as long as we have that conflict going on in Ukraine right now, and you have an economy that's not in a funk and is actually continuing to to move higher, albeit at lower levels. Looking at Egypt, again, more collateral fallout from the Russian invasion of Ukraine. So Ukraine was kind of the grains breadbasket and chief exporter into the third world, particularly in Africa, Middle East, etc. And so this is kind of a proxy, if you will, for what's going on all across that third world right now. They're witnessing major inflation. You see Egypt right now selling off state-owned assets to try to get more foreign investment to help fight this inflationary figure. Again, you're chasing more money into where there are fewer goods, and so the inflation in that respect is probably going to be self-sustaining. But clearly, if you look at this from the beginning of 2022, you can see a very discernible impact from the Russia-Ukrainian war in terms of grain, wheat, all of those types of things, much higher. And frankly, this is what happened back at the about a similar point over a decade ago when there was a severe drought in the Ukrainian and Russian breadbaskets, and it led to the Arab Spring. So and from a geopolitical standpoint, this type of inflation can really foment a lot of societal discord. And the Census Bureau publishes a lot of data that we cite and we show here. And they recently cobbled together their own little index of economic activity, using as a composite all of the other things that they measure. So this represents that, and you can see, they overlay the global financial crisis in that first larger recession shaded bar there, and then you see the pandemic impact. And so, I mean, there's a lot of noise to this, a lot of fluctuation around this line of diffusion, if you will. Right now we had seen a bit of a contraction in economic activity that has kind of reversed. We're more or less at the flat line in terms of what this chart is trying to tell us, but clearly we're coming off of a period of outsized growth in economic activity, and probably as we look at this chart a year from now, it's probably going to show us kind of fluctuating around that zero line quite a bit. Monthly trade surplus or deficit, and you can see here how that's trended over the last several years in the U.S. For a long time. Actually, you got to go back to the Clinton administration. When we had a budget surplus, we had federal surpluses. To get a sense of when this was reversed. So we're importing more than we export, and we've done that for a long time. Exports. For a lot of different reasons, strong dollar not being one of those reasons why exports have rolled over. Imports have too. I think we've seen a bit of a global contraction, if you will, in overall trade, but you can see that that trade imbalance is still firmly intact, and obviously we have a massive trade deficit with China, and as we just saw a few slides ago, that trade with China, despite all these sanctions, has actually gone up a little bit. Here's petroleum consumption. And so this is a little bit of what I'm talking about here. You can see that blue line, excuse me, they're all blue, but the deep blue line represents China. And so That line has really continued to move up as their economy has evolved over the last several decades. And don't expect that line to flatten out anytime soon. You can see the U.S. Has recovered from the pandemic, as has Europe, but you can see overall petroleum consumption in Europe, where there's a much greater influence from the electric vehicle and alternative energy sources. You just see a lot of mitigation in that petroleum use in Europe. But clearly the takeaway from this is that, whatever estimates you may have for oil consumption or production, exploration, etc., China is going to continue to influence that pretty heavily. In fact, in this latest round of earnings, we had British Petroleum, BP, we had Exxon. A lot of these oil majors are reporting record profits, and they're taking a lot of heat from the Biden administration because of it. But what this is doing is almost counterproductive if you're a politician looking for renewable energy, or at least a transition to that, because all this is doing with higher energy prices and profits is further incentivizing more R&D, more development in the petroleum sector right now. And we'll talk about housing for a little bit. So got a couple of data points here. First one's Black Knight Home Price Index. Second one on the right is Freddie Mac House Price Index. Both of them are in the same ballpark and tell us the same things. In both cases, they're about 4 to 5% in terms of annual home price growth year over year, looking at the most recent analysis. And so, what we have here is January's data, and you can see the trend, you can see where we've been, and I think this is going to be a common theme. If you look over in areas, if you take out the highs and the lows, then normal price movement is about 4 to 5% a year, and that much is clear from the chart on the left. So there are some that are predicting home prices to increase. There's a lot of people predicting home prices to decrease on an annual basis by the end of this year. Really, it's kind of hard to tell. We know affordability, which we'll look at in just a second, it remains tight, and we're getting a sense too that lenders are kind of tightening their belts a little bit, and we've got several charts that will talk about that. So here's forecast percentage change per year that I mentioned. So this represents data from CoreLogic, a very reputable source of data here, and so year-over-year forecast, looking for about 3% perhaps, and overall price growth for the year after we've seen 5%. So the important takeaway from that is, while it's still positive, and again, like I mentioned, there are a lot of people that are looking for home price outright declines, and I think if you have a kind of a deeper recession, that's certainly possible, but baseline case is you just have slower growth. And I think that's all very healthy. I mean, we're seeing kind of a normalization of sorts in the housing sector. Again, we'll be interested to see the influence of some of these, construction material inventory increases that we just talked about, and also perhaps the impetus for some of these industrial commodities like copper to move a little bit higher. So anyway, a lot of moving parts here, but bottom line is that housing prices, by and large, are expected to go up, but at a lesser amount, at a lower amount than they have been. Right-hand side, drivers of affordability. Obviously, the key thing is the interest rate change and its influence on mortgage rates, even though mortgage rates are off their peak. Then we see income remaining relatively positive. Wages are higher, as we've noted, so that does help, but then it's offset by overall higher home prices. And so the net effect of all of that is negative and continued negative affordability index. Well, as we look at the market as it stands today, we've got a couple arrows here on these charts from Realtor.com, active listing counts, actually up significantly year over year. Again, conditions were very awkward this time last year. But you can see the overlay of all these prior years' data. And so, we're well below in terms of active listing count where we were in some of the later years of the last decade. But we are up year over year. And if you look at median listing prices, they're still up 8%. So people are still trying to leverage this part of the cycle and getting higher home prices, even though the number of listings that are receiving multiple offers has gone down quite a bit. And so the ability for people to get 8.1% year over year in these median listing prices is a bit of a stretch at this point. And we'll talk about bank lending standards. So this is kind of where this is going. This is something you would expect to see at this time in the economic cycle where tightening standards are increasing. Then you've got financial institutions that are reporting much lower, well, I should say, let me rephrase that, there are very fewer bankers that are reporting higher activity, meaning, looking at it through the other side, is that there's just less demand for credit right now. Banks are wanting to offer credit, but the standards are higher now than they were. Now, extrapolating that into the real economy here, I mean, on the left-hand side, we got capital goods new orders, non-defense. That's rolling over, and ISM manufacturing new orders, I see that's rolling over. And so what's happening here is that you've got tighter credit, and it's helping to exacerbate this cycle, where you have rolling over in new orders. On the right-hand side, you have the tightening standards that we just talked about overlaid against business equipment investment. So, so this is capital spending. These are capital goods orders. These are large ticket items. This is big spending that's coming down as a result of tighter credit and this kind of self-reinforcing down cycle that we're seeing right now. So these are all kind of help to reduce inflation, help to slow economic growth. I think it's clear in the data that this is happening. So, while there are still pockets of the economic data that are still really entirely positive, this is very indicative here of the environment itself slowing down and kind of reinforcing its slowdown. Well, as we transition into the stock market a little bit, this is a nice segue because it overlays in blue the tightening standards for consumer and industrial loans. Again, we've seen this through the third chart now that reinforces the notion that standards are getting tighter, which you'd expect again. And then that's overlaid with the relative performance of equities over bonds. And so the takeaway here is that when you have these periods where bank lending standards are getting tighter, that you tend to see less performance on, or less relative performance on equities relative to bonds, meaning that the bond market is expected to perhaps perform better than the stock market. And I think this year could definitely be one of those years. Again, putting last year in the rearview mirror, that was really kind of a train wreck of all sorts because of rising interest rates and a slowing economic backdrop. This year, I think, sets up better for bonds, and this, as I like to talk about correlation and predictive power and things like that, there is definitely a positive correlation here. And so, as you see tightening standards reinforce here over the last several months, and likely going forward as banks are protecting their own balance sheets, that you'll see better relative performance from bonds than stocks here over the near term. Now we'll kind of pick on the tech sector here. Now we just saw a few slides ago where hiring and layoffs have really layoffs, I should say, have really spiked for a lot of these firms. And a lot of it's in response to what you see in this chart. And this is revenues rolling over, and these are companies playing defense and wanting to make sure that their force structure is appropriate for the slower economic growth. And you can see here, the proof is in the pudding. After the pandemic demand bubble, things leveled off and then rolled over, and then we're seeing growth rates now. If you look at Microsoft, they're below where they were previously. If we look at, Apple's a different story because they bounced around a little bit more, but in a lot of these other cases, you're seeing this pronounced growth, growth deceleration rather, in technology companies right now, and particularly the large ones. Well, oddly enough, while you see a deceleration in revenue on the part of these technology companies, you have here from B of A Global Research evidence where tech inflows into the market from investors have increased and have turned positive on a 4-week moving average after having been negative for a little while. And so I think this highlights here kind of the oftentimes divergence of what goes on in the market versus what's really going on out in the economy, and even to some degree what's going on with these publicly traded firms from an operational standpoint. And so this is certainly not a byproduct of like an abundant amount of liquidity in the market. It just happens to be that you have a greater enthusiasm on the part of individual investors, and we'll see that in the AAII numbers here in a second. Well, against the backdrop of improving investor sentiment, we have the actual data on earnings. And so we've got 3 things to show you here. We've got the aggregate earnings beat for all of the companies in the S&P 500 index. The median over time is 4.9%. Right now that the earnings beat for all companies is negative for the first time since the global financial crisis. And on the right-hand side, on the upper end of this chart, you've got the median company. And this, median obviously represents the point at which half of your observed outcomes are above that point and half are below. But the beat there is right in line with about 3.5%. And so this is what's being reported in the financial press. But what underlies that, not all boats are floating. And clearly, we've talked about the tech sector. There's fund flows into technology at a time where revenues are down, and we can see here in this chart in the lower level here that tech has missed the boat entirely. In fact, their beats have been in the aggregate have been negative. Beats have gone down. Pretty disappointing performance, and so clearly this has been an anchor on the index as a whole. Taking a step back and looking at the index as a whole, looking at equities as a whole, we have kind of the time progression of earnings estimates, and they clearly have eroded over the last 6 to 9 months. As you can see on the left-hand side, this represents the aggregate earnings per share estimate for 2023. And again, we're in the second month of this, so this is kind of like forecasting at various points along here what the expectation would be for 2023 earnings once we get through with the year. And so the peak in the estimate for this year actually occurred. We had two tops there in April, and then back at May, June, around almost close to $250 per share of the index. And so you can see where we got through the fall, these estimates kept going down and down and down, and so rather precipitously. And so where we sit now, is a degradation of about 11% or so in the earnings estimate looking into this year. On the right-hand side, we have the actual earnings in billions of dollars, and so these estimates are falling as well. So it's like looking at the same trend but in different data. And you can see where, ever since like June here, we see that those estimates have continued to drop like a rock. And then down below, you can see where they've really gone down. And we've already talked about IT earnings, and at least the current quarter has been pretty disappointing for technology. But here you can see where these estimates have really dropped like a rock. Industrials, materials, cyclical stocks. You've got communication services and technology, of course, real estate, energy, and then really just about every sector is negative. But obviously, as I just mentioned, not all boats are moving in the same direction, and there's clearly a divergence, and some sectors are clearly doing a lot worse. Now, here's some historical perspective on inflation and the S&P 500. And so, we had peak inflation back in June, and so historically, going back to World War II, all other things being equal, that the S&P 500 tends to bottom out about 7 months after that peak inflation point, which would, in that case, be January. And so, we've begun to rally already. We've had a better market environment. The markets are positive for the year, and I think very few people would have really expected that type of activity. But again, if you're looking at it just on that level, this is actually pretty consistent with history here. You see, in the data here that you've got inflation moving lower, and then you have the equity markets kind of lagging, kind of hanging around for a while before they get their footing. And this is actually consistent in many respects with this notion that the equity market will begin to anticipate the next market cycle. It will begin to anticipate the end of interest rate increases. It will begin to anticipate, where inflation begins to kind of finally settle out. And then the markets, once they get complacent with a landing spot on all this, even if inflation's at 3.5%, then I think you'll start to see more investor interest, even though I don't think multiples are going to really rocket higher. But again, this chart shows you that with that lag, the equity markets begin to move in a positive direction. As we talk about what's going on in the market and where sentiment is right now, we're looking at insider transactions. So, we've seen a pretty high level of insider trading activity, and this is actually a little bit bearish. So this is kind of what executives are doing with their own stocks, and they're selling out there, and so we see a high bearish ratio there. And then on the right-hand side, we've got a CFO survey that seems to contradict that, that they're becoming more optimistic, which is pretty interesting. Here is the AAII spread, bull-bear spread, and you see that moving noticeably higher. So this is indicative of individual investors, as the American Association of Individual Investors, AAII index, showing that the individual investor is getting more optimistic. So we know that investors are a little bit more optimistic now, and these charts kind of reinforce the notion of what the individual investor is thinking. And so left-hand side is basically a chart looking at the beginning of a bear market and how it paces, whether you're in inflation or not. And so the dotted line within that shaded area represents what happens to the S&P. Generally speaking, if you don't have a recession, right, then you recover and you move higher. And then the solid green line there, that dark green line within the shaded area, represents where the market goes if you wind up having a recession. And you can see that dark, kind of a darker black line that's in between those two right now, kind of suggests that with this optimism that the market is acting as if we're not going to be in recession, or that the conditions will be fairly benign before they get better. And so there could be a day of reckoning if we do go into recession, if history proves prescient here. The shaded area itself just represents the entire range of outcomes going from the 10th to the 90th percentile. So that captures most years, and you can see the range is pretty broad. But again, we're certainly acting in a more optimistic way right now. On the right-hand side, we have activity and investor positioning in equities by different groups. And so the purple represents essentially the individual investor, and you can see that they've gone really strongly back into equities, and that's what's helping to drive some of this current market environment. Last few charts here pertain to immigration, what I thought is pretty interesting. So a lot of conversation about our immigration policy and the fact that we're losing workers, and typically where we've gained productivity is by continuing to naturalize citizens that have come into the country from other places. And we see a lot of interdictions at the border, and this represents actually apprehensions by border police, and you can see where the last 2 years it's been extraordinarily high. Whereas looking at the number of visas that are issued to allow people into the States, the current forecast there, that's in a more lightly shaded red area for 2023, is essentially the cap that Homeland Security has established for the number of essentially H-2B visas that they're willing to issue. But you can see that last 3 years, I mean, the trend is certainly positive after the pandemic shutdown. And so if you back out the pandemic, I mean, this has been a pretty strong uptrend just in the aggregate number. And so obviously we need immigration to work for our favor to help keep inflation low, and this is a strong source of labor, and both from a skilled and semi-skilled point of view. Well, the last chart we have here is rather interesting. So, when people talk about, the degree to which U.S. subsidizes Latin America, I think it's summed up pretty well in this chart. So these are remittances back into these countries from workers that are here in the U.S. And interestingly enough, this does not even capture like illegal workers that are obviously not being captured in the formal reporting process, but you can see here how that number's really spiked. And so, we're sending about 135, $140 billion back into Central and Latin America. So, it's just, this is an indication of how, even though the government's not involved, but there is a tremendous amount of financial subsidy that's hitting these markets. Well, that's going to do it for the chart pack this week. Hope you've enjoyed it. Again, welcome to our new name change. We'll be changing our website here in the coming weeks, but as well as our email addresses over time. So hope you've enjoyed it. Hope you have a great week, and we'll talk to you again soon. Take care. Bye.